Hello there. So my name is Angela Wood. For those that don't know me, I'm the Managing Director of ETC Tax. I'm also a Chartered Tax Advisor, and today I'm going to be talking to you about adding value through tax. So key conversations that as accountants you could and should be having with your SME business clients or indeed any clients. Now, I'm sure a lot of you are already having these conversations, so as much as anything, this will be hopefully a reminder for you. And as I said, today's session is primarily an awareness session focused on the types of topics that we see come up most often in conversation with the clients that we speak to and the things that they are worried about and want to talk to their advisors about. So let's get started. So first thing to say is, and I'm sure you're well aware of this, that tax advice is not just for year end. Unfortunately, we hear time and time again from clients that they don't always hear from their accountants, except where there is something specific to discuss, and that the conversations that take place around tax tend to take place around year end, so sort of January time when tax returns are due, or in March when we're coming up towards the 5th of April and thinking about using allowances and things. So that's something we need to kind of move away from. And to be fair, I think most clients are sort of also stuck in that mindset a little bit of just thinking about tax at sort of various points throughout the year. So we need to kind of educate them around that. And the problem with that, of course, is by the time we get to January and March, options might be limited. So planning really needs to happen in real time. Reactive work is needed, of course, and that is the reporting side, but the real value will come from the strategic planning, so tax efficient structures, reliefs and allowances, and things that clients might not even know exist. So that is the role of a proactive advisor, I suppose, is having those conversations with clients in a timely fashion. And proactivity means looking ahead, really, and often looking perhaps even 12 to 18 months ahead. And what is, thinking about what is the business trajectory? Are they planning to raise funds? Are they planning to sell? Are they thinking of bringing in family members? So we're going to look today at each phase of sort of the business life cycle, I suppose, from startup through to exit. Now, obviously, no sort of business journey is the same as any other business journey. So this is just sort of a guide, and it may be that at different points in the business life cycle, different clients experience different things, but we've just set it out this way just for ease today. So getting started, when we're getting started, the first thing we're going to be thinking about, one of the first things we're going to be thinking about is structuring the business. Now, again, this is not going to be new to a lot of you or anything that is going to surprise you, thinking about whether that business should be operated as a sole trader, business in partnership, or whether we think about setting up an incorporated entity. So obviously sole traders partnerships, that's easier to set up, but we know that alongside sort of the tax considerations, there are also other commercial considerations, like the fact that those entities don't have limited liability unless, of course, you're using an LLP. And sometimes there are limited planning options with using sole trader and partnership businesses. For example, those businesses don't have access to CDIS and EIS tax relief, or things like R&D and patent box tax relief. So whilst we know that companies don't offer the tax benefits that they once did, given that the dividend allowance is now at only £500 and that the dividend rates have increased, it may still be worth incorporating for some clients. And it's always worth looking at the wider considerations as well as the tax and accounting considerations to work out whether that's right for a client. We do also, of course, model that from the point of view of the tax and financial side, so looking at NICs, corporation tax dividends, and doing some comparative costs. But as I say, there may be strong non-tax reasons to incorporate. So it's important that as much as possible we're thinking forwards a good couple of years into the plans that business has in terms of its growth. So then we're going to perhaps be looking at getting funding, or clients are getting funding and investment. So again, most of you will be very familiar with the concepts of CDIS and EIS tax relief, very popular ways to raise investment in early stage business. I'm not going to go into a lot of detail on these. Suffice it to say that for CDIS, there's a 50% income tax relief and a CGT exemption, and for EIS, it's a 30% income tax relief and a CGT deferral. So you'll be aware, I'm sure, but if you're not, feel free to pop any queries to us, that there are strict time and size limits that apply in relation to companies and whether they will therefore qualify for CDIS or EIS tax relief. So you need to be on top of this and make sure that clients aren't sort of timed out as such. We have had situations in which clients have come to us and unfortunately they were no longer able to they didn't satisfy the conditions for EIS or CDIS funding, as they were beyond those sort of time windows, etc. So we mentioned earlier that sole traders also don't qualify for this. So if your client is going to be seeking funding, then it's important to get that structure in place quite early doors. And then we can look at obtaining the advanced assurance from HMRC, which de-risks the whole process. So that's always an important part of this. Other ways of getting funding or getting funding the business, obviously directors' loans, popular. We know, of course, that overdrawn DLAs trigger a 33.75% tax charge if not repaid within 9 months of the end of the accounting period, and that they can be classed as a benefit in kind if they're written off or otherwise interest-free. So we find that clients often treat DLAs quite casually. It's the whole idea that it's my business, so it's my money. And we find that increasingly this is an area that HMRC can get quite interested in. So record keeping for DLAs is really important and really matters. Then we've got R&D and patent box, and again, well understood in most cases, R&D. I think you'll be very aware, I'm sure, that there is much more scrutiny of R&D claims than there once was, and the HMRC have really sought to sort of crack down on spurious claims. Robust claims are still important, though. Claims that are for genuine R&D, very important. Huge benefit for clients. And there's a couple of points I suppose I want to mention on that specifically. I think that for most cases, clients have a decent understanding or have an idea of what R&D tax relief is, but there's sometimes a confusion between the difference between what constitutes R&D for commercial purposes and what constitutes R&D for tax purposes. So that's important. It's important to make that distinction to ensure that the claim is robust as possible and we can guide clients through that process. And also, we've now got, of course, the requirement to pre-notify an R&D claim within 6 months of the end of the accounting period in which the R&D incurred, if this is a first claim or the first claim in a couple of years. So that is important. And we have had clients, again, miss out on R&D tax relief because they haven't notified HMRC of their intention to claim. So that's obviously a relatively new thing. Patent box, again, worth mentioning because this is a really overlooked tax relief. As the name suggests, it applies to companies that have registered patents. They must elect into the regime within 2 years from the end of the accounting period. There are other conditions that apply, but those are the things that I want to flag today. And in situations where patent box relief does apply, then 10% of the qualifying profits related to the patentable activity will qualify for tax relief. So again, always worth asking clients whether they have any registered patents in place and thinking about patent box if your clients are in the sort of in that space. So I've just got some case studies as we go throughout the kind of webinar today, and I'm not going to read the case studies out. I'm going to give just a pause for a couple of minutes to give you time to sort of scan over and digest the case studies, but you'll get the slides after this webinar so you can look at these at your leisure. All of the case studies, we've put some sort of some names in here to disguise the clients, but they are genuine case studies. They are businesses that we have worked with in the last few years, helping them along the way. So this is a case study relating to Sam, who was a startup, running a startup business, an engineering consultant, and began trading as a sole trader in 2021. But in this case, he was looking for funding. He did have some eligible R&D expenditure, and therefore it was right for him to incorporate that business. There were other considerations, say it wasn't just a tax exercise. We did also model this, which you'll see on the next slide, but ultimately this produced a tax saving for him, but ultimately was the right structure for him going forwards. So with Sam, as I say, we know that the tax benefits, as I say, of incorporated businesses aren't what they once were. So the net cash position for Sam was almost identical after tax to the position when he was a sole trader. So there wasn't a huge tax saving for him. The thing here is that he had been able to raise his £100,000 in CDIS funding. He was able to access just nearly £14,000 in R&D tax savings, and obviously, say the wider issues in terms of separating business and commercial risk. And Sam has some quite big growth ambitions, so for him, incorporation was part of a future plan and a future strategy. So that was a really important thing for him as well, looking forwards and thinking about what he wanted to achieve. So once we've got past the startup phase, we're starting to think about growing the business. And one of the things we might be thinking about, or clients might be thinking about, is employee incentivization. I mean, this could apply equally to directors and incentivizing the directors themselves. And some of the points on here, are more often seen in relation to directors, not always. But I'm just going to start with sort of the very basics. So we can obviously look at performance-related cash bonuses. We know that these are simple. We also know that they're fully taxable and subject to NIC. They can be structured with salary sacrifice, which is obviously a win-win in terms of reducing both the tax bill for the employer and the employee. But obviously they're fairly tax inefficient in terms of triggering higher rate tax liabilities, etc. So you'll all be very familiar with the process there. And then benefits, again, nothing surprising here. Things like electric cars, pension contributions, cycle to work, the list is endless. Making sure, I suppose, that we are claiming everything that we can claim in terms of allowances, things like work at home, but also looking more widely at some of the bigger savings options, particularly things like electric cars, which are obviously very popular at the moment, given the 2% benefit in kind rate. So can be a no-brainer. I think the thing that I want to focus on, though, in terms of employee incentivization is again, perhaps an obvious thing, but share schemes, which are increasingly popular as a way to incentivize employees. EMIs, I haven't listed everything on here. There are other options available in terms of share schemes and share scheme arrangements. I've just listed the ones that we come across most often in practice. So EMI, still popular, obviously a tax advantage scheme for qualifying companies, so no income tax on grant or exercise, 10% CGT on exit if BADR conditions are satisfied, £250,000 limit for each employee, and the options must be ordinary shares. With EMI, you need a proper valuation, which we can assist clients with, and we need to notify HMRC within 92 days. So there are quite some strict rules around EMI, but for some clients, it works very, very well. An alternative would be the CSOP, which recently, 2023, we've now got up to £60,000 per employee that can be awarded by way of CSOP shares. That was 30,000, so we've had a doubling there. And again, similar benefits to EMI, but lot fewer conditions. So that can be a good fallback for some clients. Some clients have both options running alongside each other. Could be take care there, but they access both. And then unimproved options, again, flexible, obviously, because they aren't improved, there's no conditions that apply, but will trigger income tax and NIC. So, have their place, but again, tread carefully there. And then we've got growth shares, which increasingly are very popular with clients. The critical thing with growth shares is the valuation again. The difference here is there is no pre-approval process for getting a valuation approved by HMRC in relation to growth shares anymore. The only valuation they will approve is for an EMI share scheme in terms of like upfront, so sort of pre-approval, pre-shares being granted or options being granted. So growth shares, again, valuations is critical because what we're doing is we're freezing the value of the company at that date based on its current value, and that's our sort of hurdle. And then on that basis, there'll be no tax to pay if structured correctly until those shares are sold or otherwise disposed of. So there is a process by which we can kind of seek a post-transaction valuation sort of assurance from HMRC. We do that occasionally, but say generally for growth shares, you can't get HMRC approval. So it's important that that valuation is robust and done correctly, which we often assist clients with sort of valuations for growth share arrangements. Just a few practical considerations. Again, Section 431 elections, something you've come across, I'm sure. Belt and braces, often advise clients to enter into those regardless, ensure that income tax on shares is mitigated, so that's can be quite helpful. Valuations we've talked about, and obviously reduce the risk of over or under taxation. So getting a robust valuation is important. And obviously we have clients with all sorts of situations. So we're currently doing a valuation for a loss-making company, which is obviously a bit different, looking at hope value and things. We've also often, startup businesses or early stage businesses can be loss-making, so that's a sort of different principle. We also have very asset-heavy businesses, so property businesses that require a different type of valuation, and then you've got your trading businesses, We've also had, we're also doing evaluation at the moment for a client that's gone through several rounds of funding. So that's quite complex in terms of the various share mechanisms and shareholders agreements and how those different classes of shares get valued. So valuations can be quite tricky, but that's something we are increasingly looking at for clients. And then we've got to think about things like good and bad leaver provisions. So when might employees be required to forfeit their shares if they leave, so if they retire, if they get unwell, if they're dismissed, and how are those shares brought back into the company? Are they brought back by the company, etc.? What are the tax consequences there, if any? Thinking about dilution and how that impacts the current shareholders, and thinking about planning for business asset disposal relief on a future exit. So for those key employees, making sure they can access BADR in terms of the conditions there that apply in relation to their shares. So again, I've got a case study here. This is Tahir. He was a trading company owner, run a SaaS business, a team of 5. He wanted to retain his key staff. I think of the 5, 3 were absolutely critical to his business operation. He wasn't interested in cash bonuses, particularly, neither were the employees, and he didn't want to dilute himself down too early. So we looked at EMI for Tahir. And that worked very well for him. So we got the HMRC approval for the valuation, and then we structured that vesting over a 3-year period to support retention. So that was great for him. So thinking again about, we're still in growth phase, VAT, which is everyone's favourite topic. I know that as accountants, tax advisors, we love VAT, a lot of us, but it's important to think about. And I think on a basic level, I think most of us would be all over thinking about when someone reaches the VAT turnover threshold of £90,000, making sure that we monitor that closely. But there are also situations in which clients might want to voluntarily register for VAT, which we see less often, especially where there's some substantial input VAT costs, early stage costs up front, and those the client wants to recover those. So there's a lot of initial capital investment going in, for example, early days. And some clients just want to VAT register so they can appear more established as a business. Really, it gives them sort of a bit more kudos, I suppose. So we do have that as well. Thinking about, which again, I'm sure as accountants, you'll be all over the different types of schemes that might apply. So whether it's a cash-based scheme or an accruals-based scheme, and how that improves the cash flow position. Thinking about flat rate scheme, and again, which might benefit the business, small business initially, but less efficient then as margins shrink. Also thinking about international sales, and particularly now that we are well into Brexit, thinking about when clients are required to register overseas if they are making supplies overseas, particularly in relation to business to consumer supplies, and particularly in relation to digital and online supplies. So will and when will they be required to register overseas? And those thresholds are very low. So clients often, we find, have already breached those VAT registration thresholds without knowing that they were required to register. So it's important to kind of stay on top of that. And if you have clients that are operating, either selling online or selling otherwise overseas, then feel free to reach out to us and we can guide you on that. We've obviously got to think about partially exempt businesses as well, so making sure that the input VAT is apportioned correctly between the VATable or taxable supplies and the non-VATable supplies, particularly relevant for finance, property and healthcare businesses. So again, those are the main businesses that we see where there is a partial exemption requirement. There are others, but those are the main businesses that we come across. And then finally, although we've not mentioned groups yet, thinking about when clients, which they often do, start to form small groups, particularly with holding companies and things, whether there should be a VAT group registration, which can help streamline compliance. It's not right for everybody. It can be helpful. And again, that requires proper thought. So we're growing the business nicely, or we have been growing the business nicely, and now we're kind of clients getting to the point where it's getting to be quite a mature business. Everything's kind of rolling along nicely, and they're thinking about other things. And one of the things they might be thinking about is acquiring a business premises or incurring some significant capital expenditure in other regards. So again, none of this will be particularly new. These are just reminders, but thinking about from a capital allowances point of view, the annual investment allowance, which is £1 million, of course, and full expensing, both available to clients, giving full corporation tax relief in the year of spend. And the timing is key there, aligning the spend with profits really to maximise the benefits. So we've got a client that we are working with at the moment through an accountant who is buying these kind of car repair pods, I think they are, like sort of that pop up sort of in supermarket car parks and things, and he's buying a whole load of those at once. He started off with sort of dipping his toe in the water to having a couple, and now he's buying sort of 10, 12, and there's some significant capital expenditure there. So we've been looking at a capital analysis exercise for him, making sure that we are fully aware of what he can claim and maximising the relief on that capital spend. And then clients might be thinking about buying a premises, and again, thinking about whether they buy that personally or through their company. And again, looking at the pros and cons of that, which won't just be tax, of course. If a client owns a property personally, then they will be obviously that property will be protected from business risk. In that case, a commercial rent can and often should be charged to the company to get everything on an arm's length basis. However, if the property is owned by the company, that might simplify things. So again, we need to look at, again, the kind of initial plan, but also thinking ahead if we can a little bit as to what the future plan might be for that property. For example, does the client want to retain that property, or might they want to retain that property in the future beyond the date at which they run the business, for example? Might form part of someone's pension arrangement or something like that. So yeah, be mindful of those kind of things. And then thinking about SDLT as well. SDLT is very tricky when we've got transfers of property between connected persons. So and so to and from their companies. So if someone is transferring a property from, their own ownership into a company that is owned by them, that can trigger some quite interesting SDLT issues. So if we are moving property around, that's something that needs careful consideration and careful looking at as well. Holding companies, this is really kind of one of the most popular questions we get asked at the moment, is should I form a holding company? Should I form a group? When should I form a holding company? How do I do it? Why would I do it? And the answer is there is no one answer. It has to be very client specific. And for some clients, it will be the right thing to do, particularly where they've got different business streams. So again, although it's not a specific case study, I've got a client at the moment I'm working at who runs festivals, who runs festivals. And she has the festival side of the business, but she also has some mascots that she has designed and developed around the festivals and the IP associated with those mascots. She wants to keep that separately to the sort of main trading business, if you like, and there's good reasons for doing that. So where people have valuable or clients have valuable assets like intellectual property and intangible assets like intellectual property, there are often good reasons to separate out intellectual property from the main trading business, and both for tax purposes and commercial purposes. So that's kind of the flags or the triggers you might be looking for there. And also in relation to property, which we mentioned on the last slide, if clients hold property, they might want to hold that for a separate property company. So we used to have the idea of like a propco, opco structure, so the property company and the operating company being the trading business, and keeping those things separate. So again, yeah, very client specific. The mechanism for forming a group is relatively straightforward. It's usually done by way of a share for share exchange, which is tax neutral in 99% of cases. We get clearance for that. Still requires careful thought, making sure conditions are satisfied, making sure there's nothing that's going to cause a problem, especially where assets or subsidiaries might be leaving the group in the future or in the short term. We need to look at that quite carefully. But we know that once we're in a group, we've got access to capital gains tax relief between the companies in that group and SDLT group relief. We've also got loss relief between companies in a group. So it's very efficient once that group is formed to move assets and losses around within the group. I think one word of caution, though, that it's not always easy to unwind a group. So, I mean, it's okay and it's possible to sell subsidiaries out of groups, for example, and look at things like substantial shareholders exemption on sale, and that can all be done normally very tax neutrally. We can look at moving assets out by way of demerger. We'll come on to that later. I think the point that I'm making is if we aren't selling the company, but at some point we decide we don't need the holdco, or the client decides they don't need the holdco anymore, it's actually not that easy to unwind that holdco structure. So if we've got a client that's got, I don't know, just a trading business with a holdco above it, and then they think, well, I don't actually really need this holdco, it's not serving any purpose, then that can be a bit tricky. So yeah, it's important to think about the business streams or the different assets when we're thinking about whether a group or a holding company situation is right for a client. Again, I've got a bit of a case study here. Just give a couple of minutes just to digest, but as I say, you can read these at your leisure. Ella was an e-commerce entrepreneur. She ran a digital media company. She had branched out into software licensing and a couple of other things around e-commerce. And so she wanted to separate that intellectual property from her main trading business. So we did look at a group situation for her, which worked very well for her. And again, in terms of what she wanted to achieve, very ambitious, had huge growth plans. She's done really well actually since. This is probably about 18 months ago, and I know that she's really grown the business since then. So yeah, that was the right thing for her in that situation. Thinking then about profit extraction. So I don't really mean now dividends versus salary versus pensions. We've kind of done all that, and we need to keep that kind of constantly in check, and we need to check in on that most years as part of our sort of normal conversation. But I'm thinking about the situation where clients have access to all the income they need, and actually they're starting to build up retained profits in the business. They perhaps don't need access to those retained profits. They don't need any more income. They are quite keen to pass some of that wealth on to family members. And how do they go about doing that? So they could make a direct gift of shares, of course, to family members. That might trigger a CGT charge, although in most cases holdover relief would apply if that's a gift of trading shares. And that would be a potentially exempt transfer for inheritance tax purposes. So, that is a possibility, but a lot of clients like to retain an element of control around those shares, and this is where family investment companies and trusts will come in to assist with that. So family investment companies, buzzword, lots of talk about FICs. They are not mystical beasts. They are just companies like any other company, a private limited company with family members as shareholders. And the key thing with family investment companies is that they have these alphabet shares which allow the control and income to be separated between those different classes of shareholders. So capital rights can be allocated, and also, sorry, I should say capital rights can then also be allocated as to current value and future growth in value. So really flexible vehicles in terms of thinking about income, thinking about voting rights, and thinking about capital rights, both current capital value and future capital value, and how we separate that out between different classes of shareholders and different family members. So ideal for directors who want to retain control but pass wealth down. Yeah, that works really well. We can also look at, and I quite often do look at, putting a trust in place in addition to protect some of the current value. If we've got a trading business at the moment, we could look at putting most of that value into a trust without triggering an IHT charge. There are changes obviously coming in April 26, which I think I mentioned on the next slide. And again, from a capital gains tax point of view, because it's a gift to trust of shares, the other holdover relief will apply on the transfer of those shares to the trust. So no CGT issues there. So I've got this case study again. This is actually a live case that we're working on at the moment. So we're sort of finalising this at the moment with Harry, who is a hotelier. He's got a hotel business worth 3.5 million down in Norfolk. He wants to pass wealth to his children, reduce his IHT exposure, and retain control. So I thought their gifting shares would trigger large CGT, but it wouldn't actually, because that's not correct, sorry, because this is although it's a hotel business, it is a trading business. So at the moment he would be looking at CGT holdover. Oh no, sorry, I'm getting myself confused. Yes, if he was gifting shares directly to his kids, he could claim holdover relief, I'm right. But he wants to kind of protect, he doesn't want to make a direct gift, I should say, sorry, getting confused there. He wants to keep control. So again, we've looked at the family investment company, we've looked at a trust above that. He is going to give the vast majority of his shares in the FIC to the trust, and because we are doing this right now, we've still got 100% business relief, which will apply on transfers of shares in this trading business to the trust, with no IHT lifetime charge, so no chargeable lifetime transfer. Obviously, that will change post April 26 when we've got a limit of £1 million that we can transfer into trust without triggering a lifetime charge for IHT purposes. So he's going to retain a few shares just from the point of view of getting flexibility around his own income requirements, but actually most of that will be transferred, most of those shares will be transferred into trust for the benefit of his family, children and future grandchildren. So yeah, sorry about that confusion, but there's that case study. So we're now thinking about exit. We're planning to exit and we're preparing to sell. And what do we need to think about then? And what do we need to be talking to clients about, I should say? Again, valuation, obviously, key. Early valuation work will inform often the deal structure itself in terms of what that looks like, what the consideration structure might look like, whether it's upfront, deferred consideration, etc., performance based. And then we can also clarify where we are in terms of the business asset disposal relief and eligibility for that. So looking at things early allows us also to identify non-trading assets early, so we can plan around that. I'll talk about that in a minute, and make the shares as attractive as possible, I suppose, to a future buyer. So we may look at restructuring. We need to think about whether, we don't need to, but it's useful to think about whether there is a share or asset sale that's likely to be more beneficial, what's likely to be more beneficial. Buyers will often want to buy assets, not always, but often, because they can leave behind then any historic risk. Sellers will often, not always, want to sell shares because that means they can sell everything nice and neatly and it's all packaged up. So again, like thinking about some of these things, thinking about removing any dormant entities. So if we have set up subsidiaries that are no longer active, let's kind of get those off, get those out of the way, make it all nice and clean for our buyer. Perhaps ring fencing any assets via demergers. So we'll come on to that in the next case study, but thinking about in this next case study, a property that the buyer would not want to acquire, or more importantly, actually, for our client, the seller client wanted to retain the property, so wanted to separate that out prior to sale. Thinking about ensuring the balance sheet is tidy, so repaying any director's loans, talked about that earlier, declaring any dividends, writing off any old loans, so getting everything in good order, really. And then the last point there, self-diligence. I mean, what I mean by that is that buyers will want to do their own due diligence, clearly, but we can help clients with cleaning up their records, addressing any tax risks that we might come across, to sort of going through that process with them in advance of an exit, updating a share register. We don't do that, but advise them to do that, etc. So just getting everything in order, really. And I have the advantage, I suppose, of having worked in tax for 20 years, 10 years at ETC and 10 years nearly as a tax lawyer, working on a lot of M&A transactions, of seeing, it was not an advantage, but of seeing many deals nearly fall over, in some cases have fallen over due to not having a tidy position, or not being ready for sale ultimately. And that's can be a very scary position, obviously, for clients who have worked really hard and have then built themselves up to this exit, and then actually everything can come crashing down around their ears. So we operate as a business these kind of pre-sale health checks, which encompass all of those things on that list, really. Ideally, we would be looking at doing that 18 months to 2 years prior to an exit. Often we don't get that chance, but that's why if we or you as advisors, accountants, can have those conversations with your clients early doors, and then involve us if you need to, then this just kind of sets the wheels in motion much earlier, and much less panicked than it would otherwise be. We've got a transaction that we're working on at the moment that was due to complete on the 16th of July, has been pushed back to the 31st of July, but that client has really tried to do everything within a 6-week period, and he's incredibly stressed right now. And we're looking at a demerger for him. In fact, he's my next case study. And or we have done a demerger for him. We've had to obtain clearance, and then we're now looking at the sales process in terms of looking at tax warranties, indemnities, advising on the consideration structure and everything. But it's all happening together, and that is stressful for everybody concerned. So try to avoid that if possible. So yeah, Edward, it's not called Edward, but Edward, the exit ready entrepreneur, they own 100% jointly of a healthcare business. They were going to sell to a PE firm. They're not now, actually, they're selling to a third party, just a trade sale. But in any event, they had built up cash, and they also owned a property within the company. They wanted to retain the property as part of their income in retirement, so to continue to receive a rental income on that. It's likely that the buyer business will continue to let that property from them once they acquire the business. So we needed to move that property out, and we did that by way of a capital reduction demerger into a new company. We obtained clearance for that, and then we're going through the whole sales process now. But it was so I've just realised that says Ellie at the bottom, it should say Edward. But it was yeah, it was, and it's quite stressful. So if we can get our ducks in a row early, then that is much more helpful. So finally, and I know I've whizzed through here, and I think I was looking at an hour, but I've gone through quite quickly, so hopefully everyone's been able to follow it. But we're coming to the last couple of slides now, and then we're thinking now about beyond an exit. So once we've achieved our exit, or clients have achieved the exit, they're obviously often sitting on a pot of cash, which we know is not very tax efficient from an IHT point of view. So important then to revisit the whole inheritance tax position and think about what clients have in terms of their overall wealth with the pot of cash that they've received from the business sale and what they want to do with that. And this is where, for me, I would consider then introducing a financial advisor into the picture. You will have your own contacts. I'm sure if you don't, we can help with that. But to model the client's income requirements, especially if it's part of a retirement plan, the sale. So, thinking about what they need, how they will invest some of that cash to achieve their income, and then giving away perhaps some of the excess if that's what they want to do. So that's something that a good financial advisor will work with the clients on. And clients, the biggest thing for me with IHT is they often they want to reduce their inheritance tax liability, but they don't know how much they need to keep for a rainy day or for their own requirements. And that's not really something that we do, but it's something that a good financial advisor will help them try to do. It's obviously not precise because nobody's got a crystal ball. But that's where we get involved still with clients and sort of working with financial advisors and also working with lawyers, helping them to, lawyers, that is, helping them to update their wills. Once they've sold the business, there might have been some changes there. But I think as accountants, as the client's trusted advisor, you can make yourself that single point of contact. So bring in the experts for them, bring in us if you want to, ETC tax, specialist tax, bring in lawyers, bring in financial advisors, whatever it is that the client needs, and kind of make yourself indispensable for the clients, that you are that single point of contact, really. Make yourself the go-to. We often have clients once they've sold business thinking about charity and charitable giving. And again, obviously from an IHT point of view, I say obviously, it may not be obvious. If clients are giving away 10% or more of their net estate, then their IHT rate that will apply on death will be reduced to 36%. So that's quite interesting for some clients. We have some clients that want to go all out and set up full-on charitable foundations, and that can be quite interesting. And we have done some work with clients, a couple of clients who've set up charitable foundations or community interest companies and things like that, which again have some sort of tax angles, as you might expect, and obviously getting lawyers involved that know what they're doing on that kind of stuff. And then some clients at this point will want to start again. So we're back to slide one. They may be serial entrepreneurs, they might have sold and then they might be moving on to the next business. So that would be great from the point of view of, you staying there with them for that journey and going back to start again. So that's where we might be with some clients. So key takeaways then, really, and I say I'm coming to conclusion now. I think the point that I'm making is engage with clients regularly, as regularly as you can. I mean, again, some clients, some accountants do that and do it very well. Some do it infrequently, some don't do it at all. But the biggest complaint we get from clients that come to us directly, i.e. not through their proactive accountants, is that they don't hear from their accountants except when there's something that needs doing or something that needs filing. And they therefore feel that they are not receiving that proactive advice that they think they might need. So, building in things like quarterly or biannual review meetings, whatever it is that suits you, and charging for them if you want to, of course, or building that into your fee structure. I think the critical thing as well is just asking questions and asking questions early enough. Is okay to be nosy. I think as a nation, we are reluctant to ask questions sometimes. We feel like that's a very sort of not the right thing to do. It's a very British thing, I think, but it's okay to ask about future plans, to ask them about succession, about what their thoughts are about their business, about what their thoughts are about their family, about where they want to live, all these kind of things. So that's where the risks arise. It's where the opportunities arise too, but that's where we need to be talking to clients on a regular basis and thinking about reviewing things regularly. We offer sort of a review service. So we do the pre-sale health checks, but we also have a sort of a tax review service for clients, both on a sort of corporate tax side and also on the personal tax side. So it's great that we're doing tax returns, or you guys are year on year, self-assessment and CT 600s, etc. But a tax return isn't a substitute for a sort of a full tax review. So making sure that we're talking to clients about everything and that's going on and what's keeping them awake at night, ultimately. And the right structure will obviously save the clients a lot of money and time, and you will be thanked. So that will be a happy thing. So yeah, be that trusted advisor, help clients look ahead, and make sure that planning is timely and is, you know, is well thought out and well executed. So that is all I've got to say today. So thank you for listening. I'm sorry this was in the end quite a quick sort of tour through. I think I was forgetting that because this isn't live, I haven't got questions at the end. I was allowing an hour with questions. We don't have any questions today. But if you do have questions, feel free to send those to the email address on here, inquiries@etctax.co.uk, or to contact me on LinkedIn, Angela Wood, or to have a look at our website. I'm fairly easy to find. If you put Angela Wood ETC Tax, you will find me either on LinkedIn on the website or through email, etc. So thank you for listening. I hope it's proved useful, and yes, hope to catch up with you soon. Thanks.